Hello and welcome everyone. In today's video, we will understand the concept of cash management. Every business has to maintain a cash balance to meet needs that can be managed only with cash. The convenience and liquidity associated with keeping cash also carries a cost. However, for cash does not earn return for the business. Cash management refers to management of cash balance and the bank balance, including the short term deposits. The cash is obviously the most important current assets as it is most liquid and can be used to make immediate payments. Insufficiency of cash at any stage may prevent a firm from discharging its liabilities or force it to sell its other assets immediately. Therefore, it is important to understand the concept of cash management. A finance manager in any organization is required to manage the cash flows, both inflows and outflows, arising out of operations of the firm. There are a number of motives for which firm holds the cash, as it is the most liquid asset. And some of these motives are transaction motive, precautionary motive, speculative motive, and compensation motive. So here, the first motive is transaction motive. Now, what is that? Transaction motive, it means that business firms as well as individuals keep cash because they require it for meeting demand for the cash flow arising out of their day-to-day transactions. In order to meet the obligations for cash flows arising in the normal course of business, every firm has to maintain adequate cash balance. Okay, so a firm may require the require cash for making payments for purchase of goods and services, to pay to the supplier of goods, to pay to the employees in cash, or you may be having all general operating expenses, which are also payable in cash. So, this is the motive where we are keeping or holding cash in order to meet our day to day transactions. The second motive is precautionary motive. Precautionary motive. Now, what is that? The precautionary motive for holding cash is based on the need to maintain sufficient cash to act as a cushion or buffer against unexpected events. In spite of making the best efforts, the future cash flows cannot be ascertained with 100% accuracy. One never knows about the happening of natural calamities or sudden increase in the cost of raw materials or any other factor such as strike, lockouts, etc. Such events may seriously interrupt even the best planned budget, best planned financial plans, and thus that can temporarily make the cash budget ineffective and non existent. Therefore, a firm should maintain larger cash balance than required for day to day transactions in order to avoid any unforeseen situation arising because of insufficient cash. The next motive we have is speculative motive. Now, what is that? Cash may be held for speculative purposes in order to take advantage of potential profit making situations. A firm may come across an unexpected opportunity to make profit, which is not usually available in the normal business routine. Some cash balance may be kept to take advantage of these windfalls. Example, we can have an opportunity to purchase raw materials at a heavy discount if we paid in cash. The motive to keep cash balance for these purposes is obviously speculative in nature. The firm's desire to keep some cash balance to capitalize an opportunity of making an unexpected profit is known as speculative motive. The next one is the last one. Uh, the motive for holding cash is compensation motive. So, commercial banks require that in every current account, there should always be a minimum cash balance. This minimum cash balance may vary from rupees 5,000 to rupees 10,000. This amount remains as a permanent balance with the bank so long as current account is operative. This minimum balance is generally not allowed by the bank to be used for transaction purposes, and therefore it becomes a sort of investment by the firm in the bank. In order to avail the convenience of current account, the minimum cash balance must be maintained by the firm, and this provides the compensation motive for holding cash. So, uh, if someone asks you that what is the objective of cash management, why it is so important to manage the cash, the financial manager must know as to why the cash management is a necessity. The cash management strategies are generally built around two goals. Number one, to provide cash needed to meet the obligations. And number two, to minimize the idle cash held by the firm. Therefore, uh, any firm must try to have a risk return trade off, uh, and they should try to meet the cash outflows, and they should try to optimize their cash balance, which is very important. Now, there are certain factors that may affect the cash needs of any firm. And obviously, that will be basically that financial manager has to achieve a trade-off between liquidity and profitability. And for that, some of the factors that should be kept in mind is the cash cycle, that is the uh, length of time between the payment for the purchase of raw material and the receipt of sales revenue. So, we should also take care of the cash inflows, of the cash outflows, also of the cost of cash balance. That when we are holding cash, what is the cost of it? Should Are we holding the sufficient amount, or we are holding the excess amount which is not letting us earn more? So we need to consider several factors for that. Now, this leads to a discussion of what is the optimum cash balance. Now, this is very important. Optimum cash balance. What is that? So, um, the cash budget for a firm may indicate the period when it is expected to have a shortage or surplus of funds. If a shortage is expected, ways and means of overcoming it must be thought of. And in case of expected surplus, its profitable usage in marketable securities should be explored. So we should understand that what should be done in case there is shortage of cash, and what should be done in case there we are having surplus of funds. There are number of models which discusses about the keeping the optimum cash balance. And one of the very important model is Baumol'S model. Baumol'S model. Now, it is It was given by W.J. Baumol in the year 1952. This model is same as the EOQ model that you must have studied in the inventory management. This model attempts to balance the income foregone on cash held by the firm against the transaction cost of converting cash into marketable securities or vice versa. So, the assumption of this model is that the firm uses cash at an already known rate per period. That is, the rate of use is constant. This is one of the very important assumption of this model. There are certain components of this model that we should understand. The one is holding cost. Holding cost. What is that? Holding cost is basically there's always a cost of holding cash by a firm. This cost may be opportunity cost in terms of the interest foregone on the investment of this cash. Another important component is the transaction cost. Transaction cost. So it is basically whenever cash is to be converted into marketable securities or vice versa, there's always a cost involved in a form of brokerage, commission, etc. So this model is based on the proposition that in order to reduce the holding cost, a firm keeps the least amount of cash in hand. However, as the cash level depletes, the firm can acquire cash by selling some of its marketable securities. Each time the firm transacts in this way, it bears transaction cost. So it will be like to transact as occasionally as possible. This could be done by maintaining a higher level of cash level involving high holding cost. Thus, firm has to deal with the holding cost as well as the transaction cost. The optimum cash balance is found by controlling the holding cost and transaction cost so as to minimize the total cost of holding cash. We can say that the cash is recovered by selling marketable securities in such a way that transaction cost is optimally balanced with the holding cost of cash. So this model is almost same as the EOQ model and can be presented as C, that is capital C is equal to under root. Okay, so here we have to use the symbol of under root. So I am just writing it under root, okay, 2ft. So I am writing this in the bracket 2ft divided by r. Under root 2ft divided by r. Now here C is the cash required each time to restore balance to basically minimize the cash requirements. F here is the total cash required during the year. T is the cost of each transaction between cash and marketable securities. And R is the rate of interest on marketable securities. So as per Baumol's model, the firms should start each period with the cash balance equaling C and spend gradually until its balance becomes or comes to zero. At this time, the firm should replenish the cash equaling the C from the sale of marketable securities. Okay, so if we do a question on it, suppose a firm has total cash need of say rupees 5 lakh per annum, right? Rate of interest is 15%, right? And every time it has to pay rupees 25 to to enter into a transaction of marketable securities. Then the optimal cash it requires every time can be calculated as follows. So how will we do that? So here, C, we need to calculate C here. So it will be equal to, again, under root, right? Under root, and we will be having 2FT, right? So what is F and what is T here? So we know that the total cash which is required is 5 lakh. So here 2 into 5 lakh, and our transaction cost is rupees 25, and the rate of interest on marketable securities R is 15%, that is 0.15. If we calculate this, we will get the amount as 12910. So this is the optimum cash balance that a firm must hold in order to minimize its cost. So this will be the best cash balance, which will be profitable, as well as we will be in a liquid position. So there are number of limitations also of this model. The model assumes a constant rate of use of cash. Also, the transaction cost is very difficult to measure. In spite of the limitations, uh, the model has a theoretical value. It gives an idea as to how the holding cost and transaction cost should be optimized by the firm. The cash balance being maintained by the firm should be a level close to optimum level as given by the model, so that the total cost can be minimized, right? So I hope this was understandable. If I use Excel, so I can use SQRT, square root function, and I can give this number 2 into 5 lakh into 25 divided by 0.15, and hopefully we'll get the same answer. So here it is 12909, that is very close to 12910 rupees, which is the optimum cash balance as per Baumol'S model. So I hope this video was helpful for you in understanding the concept of cash management and the very important model, that is Baumol'S model of cash management. Thank you so much for watching.